Hey, good afternoon, everyone. Marty Mazzori here, 24th of April, 2021. I decided to once again bring you our weekly macro update via video. I will be concise. I promise not take up too much of your time, hopefully keep it interesting. In front of you is our index, continuing to go nicely higher. We're presently at 31.25. That's a 4.72 move week over week. Had two inputs improve. Nothing went in the other direction. We have negative scoring inputs, but they're already as negative as they can go. The other thing that impacted the score this week is we had to drop, for the moment anyway, our number of inputs to 48 from 49. The Caterpillar global sales data, which I actually like a lot, has been suspended. They're not updating it currently, so we only have old data. So for now, we'll suspend that. Hopefully they'll bring it back, and we'll stay on the lookout for that. But 48 data points across the areas that we think are important is plenty. So again, 31.25 was our move, nicely into positive territory. Says good things about this current state of general conditions. Mortgage apps, mortgage purchase apps is what we use in our index, and they are up this last week, week over week. And so we have a higher low. We still have this downtrend here that we haven't broke above. There's some resistance right here at about 300,000 a week. Rate of change improved dramatically as well. Bottom line, interest rates came down. Also saw a big jump in the refinance numbers as well. So we're talking more about housing. Some would tell you it's beginning to look very bubbly. From a pricing standpoint, I would say, and I would still say, despite what I'm going to show you right now, that we still lack the kinds of characteristics that were really telling before the bubble burst the last time, the 2006-7 to bottom of 2009 or the beginning of 2009 experience. The statistic that is concerning about housing is certainly this one. This is the volume of cash out refinances and second mortgages, third mortgages, and so forth. So this is suddenly here just really spiked up in a big way, and you can see where things got problematic back up in here, leading into the great financial crisis. Total volume is also picking up, just the total amount of these types of loans, and that's a little different characteristic, although it was ramping up here. But that was 2002, 2003 when it became really problematic. You can see the total volume of loans was actually dropping, and the person who presented this chart didn't really point this out, so someone who commented on it did. So, whether that's meaningful or not, I think this is meaningful in terms of just what it says about consumer sentiment and optimism, which I guess is a good thing, as we explored in last week's update about the economy. But, my concern is some of the debt bubbles that are out there, particularly in corporate balance sheets, not to mention, sovereign debt on government balance sheets. And the consumer's been pretty healthy, but like I said last week, big jump month over month in consumer debt, big jump in the credit card component of that, and now apparently a big jump in cash out refis and second mortgages that we need to keep our eyes on. Next up, the other indicator that scored positively and moved the needle on our index was the Chicago Fed National Activity Index. It's an index within our index. It's 85 data points that they have. 70 of those month over month got better. Therefore, their score improved dramatically from where it was last month, and it was certainly enough for us to move that into the positive column. Other data points I just want to share with you, other inputs that didn't see a score change but are interesting to look at and important to look at. The Chemical Activity Index, think of this as early supply chain manufacturing signal, if you will. Like it a lot. It's been really good to us in terms of as an indicator about general conditions and what we should be looking out for. You can see it rolled over here right before the great financial crisis, right over here before the small recession, but epic bear market in stocks, particularly those traded on the NASDAQ indices. And right in here, prior to 2011, you can see it right, 2010, 2011, in terms of the stock market, which I don't have here. This is, again, this is this index. But in 2011, we had nearly a bear market, about 19% decline in stocks. Right in here, 2000, or actually 2010, it was a 10% correction, almost 20% in here in stocks. Up here, we had in 2015 and 16, we had two corrections that if you put them together top to bottom, we were down 16%. And then you can see we're beginning to really flatten out in here. And this is this in combination with a lot of other things we look at had us begin hedging portfolios right back here in August. Clients, as you know, we really cut a huge chunk out of the decline that most other people felt right in here. And that was because of the hedging that we did back in here. And it wasn't because of course, we didn't know that a global pandemic was coming. It's just the conditions were such that demanded that we begin to hedge a little extra because our view was that the next recession with the debt bubble underneath it virtually had to be as bad, probably worse in 2008. COVID gave the green light for the powers that be to do things that are, if you read the Federal Reserve Act, things that they weren't supposed to be able to do. But anyway, they did, and they essentially rescued the portfolios that owned what I can really legitimately say is utterly garbage corporate debt. So that is still out there. It's still in the economy. It's still in the markets. But the market's focusing on stimulus, and I get that. And that stimulus is having a real positive impact on the data, which I'm showing you in our index. So lots to be very, very aware of and to compensate for in our investment allocations going forward. The Bloomberg Commodities Index, recall that I drew this bull flag in here last time we had this discussion. I presented this as a high probability relative to other technical indicator, and that what a technician does will measure the length of the flagpole and then put it right here on top of where the market or the index or what have you we're tracking breaks out. And then you establish a price target, the length of the flagpole. It's interesting, if you look at this here, you could draw, you could kind of draw certainly a bull flag pattern, right? Big, big increase, pretty steep consolidation in this pattern. Although it looks like it's come down, but it's consolidating within a range, and then you break out. So if we were to go from here to the next top, if you look at just kind of eyeball this line and that line, sure enough, probably virtually the same length, right? We have this kind of this growing, flagging activity that, of course, isn't going to last forever, and this one may completely break down. I mean, this is quite the steep move, and that's too steep in terms of sustainability. But we'll keep our eye on that. We like commodities for reasons other than how they're technically trading, but it does help us in terms of adding to positions, cutting positions. Basically. Some of the timing issues that we have to pay attention to as we manage and adjust portfolios into the future. Price of copper, remember we did this here as well, and I was looking at this, we could probably come down here and do similar things, right? I could make that a flag maybe. Now, the breakout from here to here doesn't look like it quite, satisfied this price target. Looks a little bit shorter, but not much. And if you want to do, you draw another flag there. Actually, yeah, would have broken out here. So that flagpole doesn't look as long as this one. But again, this looks a little more classic. We did overshoot here. That was just a momentum-fueled overshoot. One of my favorite technicians likes to say. But if we break out of here, and this is way too steep. That's just not sustainable. But we did break out very strong fashion. So again, from here to here, you'd look at copper going significantly higher, and we remain bullish on the metals. I think it was in a recent blog post, I believe, I shared with you kind of our view that the next few months are going to be choppy. And I think they're going to be choppy for things like, our commodity plays as well. But again, really bullish look. And I know I did show you here in one of my morning notes, our ag ETF. And I was talking about inflation and how that is moving in a very impressive pace. So, folks, there's inflationary pressures, and I'm going to talk a little bit about that in closing here as well. The Baltic Dry Index off the proverbial charts, we must say, right up in here. So, just to kind of give you a deeper context, I talk about this one a lot, well, lately because it's going through the roof. Cost of shipping dry bulk materials across the world's oceans. So you look at this as an indicator of global construction, right? Global demand for goods, and it's not just construction materials, but everything that they ship that way. Typically you'd say that says really, really good things about the economy, but I should probably take you back a little further here, and if you go way to the left, and I'll just work with what I got here on the screen. This was the lead up to a rolling over in the index. So in 2011, that's pretty much where the last big commodity bull market peaked and rolled over. And I've shown you before the commodity index charts and the charts of even the positions we have right now, and how they show you how they're just now breaking out of it, and makes them look pretty good technically. Fundamentally speaking, though, back in here we had an absolute utter glut in things like ships, right? Because those few years where China was really working to bring people out of the fields and into the cities, and they were building cities before they had people to put in them. They were consuming like 2/3 of the copper production out there. You recall back in here, or you may recall, there were a lot of reports of people breaking into anything that they could find copper in, because copper was so incredibly expensive. Why? Because there wasn't much of it, because China was just buying it all up, because copper is in virtually everything. So anyway, this is how it happened. So you had huge expansion in the production and the delivery of commodities. So as it relates to the Baltic Dry Index, you had a surplus of ships. And then, of course, all good things come to an end. All bubbles ultimately burst. And as that commodity bubble burst, well, then just a plethora of bankruptcies happened. Huge capacity destruction during all this time as commodity prices shrank. There was just way over capacity, way too much debt in the mining space, for example. Lots and lots of trouble, lots of defaults, lots of bankruptcies. So they had 10 years to really get their respective houses in order. And I did show you recently the big run up in free cash flow across the miners and other data that we like. Very different world today, but I tell you, 10 years is not that long. And I happen to know that these folks still suffer from the PTSD that they experienced during these very tough times. So now we have, economies picking up, we have supply chain disruptions and so forth, but we have great demand relative to the capacity to produce what's demanded in the commodity space, pretty much across the board. And we don't see, rapid expansion of capacity. We will see that, but as long as we don't, or it doesn't happen overnight, as you can imagine, well, then we have huge profitability in the mining space, which we're in, and we have continued upward pressure on things like, in this case, the cost of shipping that, because they need to bring new ships now back online, or bring them out of the mothball department, or whatever they call it. And so we've got capacity constraints, and that's inflationary, no doubt about it. The debate, and we're going to get into that here in a minute, whether this is cyclical or structural, and we fall on one side of that debate, at least based on our view of current conditions. And I'll share that with you here, and I'll do it as surgically as I can. In fact, we're there. So clients, of course, and I guess longtime subscribers know that the study of economics is something I'm very passionate about. I think something that is incredibly pertinent to what we do on behalf of our clients. And so there are some really good economists that I respect their work. Someone who I'm going to talk about here in a second, I even pay him a nice premium just to get his deepest insights. Now, picking on him, and I won't name his name, if he and I were to sit and just debate inflation, he pretty much would present me to be someone who's very naive and doesn't understand how the world works, because he is very, very passionate about his inflation view. And essentially, there just isn't going to be any. Not that he completely discounts or dismisses current price increases, because you can't. He just doesn't think they're structural or long term at all. Why? Well, he likes to cite the output gap and labor slack and so forth. And this chart right here, this busy chart, is my chart of the output gap and CPI all the way back to 1960s. This is 60 years of movement, 60 years of data. And the output gap is the difference between the potential GDP, meaning what the trends suggest our economy should be growing at, versus what it's actually doing. And the difference between the two, if actual GDP is underperforming what the trend and other factors says it should be doing, well, that is an output gap. So that output gap means that underutilization of resources, you could say, underutilization of the economy's assets. Therefore, if there's underutilization, which is very contrary to what I just said, then there's no inflation, right? You've got to have the real GDP get up there to the potential in theory and exceed it before we start seeing inflation. So, but when I look at my charts and I see this is the zero line right here, right? You can see where I'm drawing. And so when you're below that, you have the output gap. This is the CPI, right? This would be your late 70s here, where early 80s, where we got to like 15% annual inflation. But I drew the 2% inflation line here because that's what the Fed's target is, then 5%, when it gets extreme. And where I'm circling it, you can see right over here to the first one to the left, you can see this output gap, right? And you can see inflation that's pretty consistently above 2%. And that would be very problematic right now, in my view, to see inflation persist for very long above 2%. Now, my economist, who I'm picking on right now, he would look at this and say, that's stupid, right? Look at the trend. You see the output gap going down, and you see inflation going down. You see the output going up, and you see inflation going up. And I would say, okay, yeah, but I see inflation still going up right here, if you're with me. And I see the output gap going down, right? So we can't just say unequivocally that these are perfectly, correlated things, right? It's just not the case, right? Here is, here it is. Here's the output gap coming up, and here's inflation, right, going down, right? So that's the opposite of what we say. But during that period, you could say that those trends exist. But my point here, and I can kind of leave it here, is that I wouldn't go there as aggressively as this one gentleman and other economists, and one strategist who's actually manages a hedge fund, who's known for his expertise in economic history, or his knowledge there, says the same thing. He said that we're just not making sense if we think inflation can turn into something longer term and structural. Well, I normally agree with that thinking. Right now, I don't. And in a nutshell, I know I've told you this before. Couple of things. Number one is this gigantic debt bubble. And again, they would say, well, what are you talking about? When there's huge debt in the system, that sucks things to the debt, to servicing the debt. That can't be inflationary. That's money that's being pulled out of the economy. Okay, I get that. Now, that debt is at exceedingly low interest rates. So we have to recognize that. And I think we have to acknowledge that the powers that be, the central banks, are committed to not letting interest rates go up and burst their respective debt bubbles. I won't show it to you now. I thought about it, but I watched a few-minute clip of ECB president, European Central Bank president, Christine Lagarde, and it's kind of frightening for folks like me, because she just basically justifies negative interest rates on and on and on, which is what you have in Europe, and really just tells savers, sorry, you're going to be sacrificed so that people will borrow real cheap and go buy things and push money into asset prices. Really, she left no room for doubt there. Just, I don't know that she is glad she posted that because, or that the ECB did, because I have to believe she is receiving intense criticism, as she should be, for making that statement. But that's how we know they think. They just generally don't come right out and say it. So my point is that as inflation continues to heat up, if it does, there's going to be pressure like we've seen on yields. People will sell bonds and go into more inflation protected securities. They'll go into other things because now they can get an interest rate on other things as well. And it's problematic for the stock market and so on too. But bond prices, meaning when you own an existing bond and it's paying, say, 2% and interest rates go to 3, you are getting creamed on that bond, particularly if it's a longer term bond. So folks know this. Bond investors know that, and they sell it. And what does the selling do? It pushes yields higher. So what will the Fed do ultimately? I think it's what they'll do in the 40s coming out of World War II, and that is institute what's called yield curve control, and literally buy those bonds as people sell them to keep interest rates at a certain fixed level, which they'll print an unlimited amount of money to do that. And then they'll continue to try to talk down inflation as they have. So I'm thinking of good old Milton Friedman. He used to talk about these kinds of shenanigans. And he said it's like being in a room where the temperature is 70 degrees, or you want it not to go above 70 degrees. But what you're really focused on is the thermometer and what people see when they walk in. So you take a wedge and you just slam it into the thermometer right at 70. So the mercury now stops. It cannot rise above 70. So you walk in, you say, what's the degrees? Well, it's 70 degrees. Well, interest rates are 2% on the 10-year treasury. Oh, okay. Well, that must mean that it's pretty cool inside, or the economy is pretty cool. We're not seeing a lot of heat. We're not seeing a lot of inflation. The problem is in that room, it's 100 degrees and you go in there and after 5 minutes, you're sweating your rear end off. But the thermometer says 70. Yeah, it's because it's been stopped at 70. It does nothing at all to do or it says nothing about the actual temperature in the room. If the Fed does yield curve control, it says nothing about the rate of inflation. So the bond market signals are gone. What does it do, if you will? Well, like the room, if the thermometer were allowed to go up, what would happen is the thermostat is probably set at something less than 100 degrees. The air conditioning would go on, right? And you'd begin to subdue the temperature in the room and make it more livable. Well, the bond yields rising equates to higher mortgage rates, higher auto loan rates, higher credit card rates, and so on. And what does that do? It slows down the borrowing and the spending in the economy. And remember, when things inflate, like I just showed you, capacity increases. So now we begin to see demand decrease because of higher interest rates, and that capacity is still there. So what happens? Inflation starts coming down. So my point here that feeds into our inflation thesis is the powers that be probably aren't going to do anything, or very, very little, to stem the tide of inflation, at least with the interest rate mechanism. Okay. The other thing is, while the Federal Reserve is being so friendly to borrowers, meaning keeping liquidity high and interest rates low, the federal government promises to spend trillions upon trillions more money. And they have a green light with COVID and with the need for infrastructure and so on. So we have easy monetary conditions and a fiscal spending impulse like nothing we previously could imagine. I don't know that inflation is going to be structural and it's going to be long lasting, higher than the 2% average or 3 or 4% and become problematic. I do feel like I know that the odds of that are greater than they've been in virtually as long as I can remember. So that is something that demands that you clients, that as we manage your stuff, that we do so in a manner that hedges to some degree, or takes against or takes advantage of these conditions that I just laid out. So hence, the commodities, which are doing very well of late, and last Monday adding Treasury inflation protected securities, in a modest amount to our fixed income exposure. In closing, our analysis is the definition of dynamic. And as I wrote just a few minutes ago and posted to you, we try to the extreme to remain unbiased, not to be bullish, not to be bearish, but to maintain complete objectivity and humility at all times, which means we are more than willing to change our direction, to make adjustments within portfolios as general conditions have us adjusting our thesis accordingly. Right now, inflation risk is pretty high. Own, at least with a portion of the portfolio, the kinds of things that do well and the kinds of things that take advantage of infrastructure spending, the kinds of things that take advantage of government green energy push, that sort of thing as well. Look at the whole framework, look at the whole environment, invest accordingly, and then recognize that stocks are at far and away all-time high valuations. These are not the conditions that are consistent with the beginning of bull markets, folks. And I would win that argument with anybody. Meaning we have huge debt on corporate balance sheets. We have record low interest rates already. So think about that. It's not that interest rates can come down, right, and add real stimulus to an economy that's about to take off. It's not that corporate balance sheets are lean like they tend to be at the beginning of bull markets, coming out of recessions and bear markets. They weren't allowed to lean out and to suffer that pain this last go around. Where you can lever up over time and take on good debt to expand your businesses, right? That tends to be factors at the beginning of bull markets. You tend to have low leverage in the market. We have the highest margin debt relative to GDP than history could ever imagine, and then other things as well. So I did this a while back. I made 5 bullet points and said these are the characteristics at the beginning of bull markets. We don't have those. We have the opposite in virtually every one of those. Does that mean the market's going to come crashing down tomorrow? No. Does that mean we should gauge our expectations of future returns accordingly down? Of course it does. You just have to. It doesn't mean returns won't be great, but we should be lowering our expectations based on these factors that I just rambled on about. And we should know the probabilities of ice breaking, using my ice skating analogy, and becoming very destructive to unknowing portfolios is higher than it's been in a long time. Doesn't mean the ice is going to break. It just means we better be doing things within portfolios to hedge against that ice breaking. Expect to go down in a big market collapse like last year. But if you're hedged properly, you're diversified properly, you should have a better experience than most people and be in a position to take advantage of those lower prices when they come. However, also be in a position that if they don't come, to make money by exploiting, if you will, the areas that are going to benefit from whatever you want to call it, the shenanigans or the efforts of the folks who print money and make policy. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.